Executor fees are always taxable to the executor. The exam twist is where you report them. If you're a one-time executor, like a friend or family member doing a favor, you usually report the fee on Form 1040 as other income. It's still income tax, but generally not self-employment tax. If you're a professional executor, that's a different story. Here's the key dividing line: trade or business versus not. On the EA exam, they love wording like as a favor versus professional fiduciary. If you're not in the business of serving as executor, your fee goes on the 1040 as other income. If you regularly do this for pay, like an attorney or professional fiduciary, you're in a trade or business, and the fee is Schedule C income. Now connect that to self-employment tax. Other income from executor fees is generally not subject to SE tax because you're not carrying on a trade or business. But Schedule C executor fees are self-employment income, so they flow to Schedule SA. A classic example is an estate attorney named Executor and paid a percentage of estate income. Those fees are both income tax and SE tax. Use the facts to classify it. If Janice is an accountant but agreed once to be executor for a friend, that's not a business activity, other income. But if John is a professional estate attorney and is executor as part of his practice, that looks like a service business. Schedule C. When you see never did this before versus longtime professional, you're being handed the answer. Now the personal risk piece. The estate's tax liability attaches to the estate assets. But if the executor distributes assets before paying the estate's taxes, the IRS can come after the executor or the beneficiaries, up to the value of what they received. On the exam, the danger phrase is premature distributions, before appraisal, before tax determined, or before taxes paid. One more nuance. An executor isn't personally on the hook just because an estate is insolvent. If there truly aren't enough assets, that's not the executor's fault. The problem is paying beneficiaries first and leaving the IRS unpaid. So the safe ordering is: identify filing requirements, value the estate, pay taxes and priority debts, then distribute what's left. Danielle is a sole proprietor nail salon owner with a net profit of $25,000. Her husband Ethan is also self-employed with a carpentry business loss of $1,500. They file jointly. How should the income and loss be reported, and what happens on Schedule SE? Does Ethan's loss reduce Danielle's self-employment earnings or not? Think about it. The correct answer is A. Each spouse reports their own sole proprietorship on a separate Schedule C, and self-employment tax is computed separately for each spouse on their own Schedule SE. So Danielle's Schedule SE is based on her $25,000 profit. The tempting wrong choice is the one that nets Ethan's loss against Danielle for SE tax. Joint return doesn't mean combined SE earnings. Rohan sells business equipment and other assets to family-related parties. Which sale is subject to the related party transaction rules? Consider options like selling to an ex-spouse, selling stock to a corporation partly owned by his wife, selling assets to a brother-in-law, or selling depreciated equipment to a trust connected to his son. Think about it. The correct answer is D, a sale of depreciated equipment to a trust in which Rohan's son is a grantor. That's a related party setup under the tax rules, so special limitations can apply. A tempting wrong answer is the brother-in-law choice. People assume in-laws are always related parties, but the related party definitions are narrower and very specific.